It's great to see so much enthusiasm on day 3 of this conference. It's going to be a busy day ahead, so I'm keen to get going so we can stick to our time today. We're going to start actually with one of the key topics for Greece, for Europe, and for the world, which is financing the future, financing growth. And we have a super panel to help us do that. So let me invite to the stage Boris Vujcic, who is the Vice President of the European Central Bank. Boris, it's a pleasure to meet you. Please take a seat. And your very own Yanis Stornadis, who is the Governor of the Bank of Greece. Good to see you again, Yanis. Thank you. Take a seat. Yes, please, if you would there. And Pavlos Mylonas, who is the Chief Executive of MBG Group. Hi. Good to see you again. Please come and join us. Okay. You each have, it says here 5 or 6 minutes. I'm going to ask you to keep it within that time, if you possibly can, so we can get some questions. Our theme is the global economy in 2026 and beyond, but obviously in the context of Europe and of Greece. So I've got plenty of questions, but first of all, let's hear from you. Some introductory thoughts on that theme, please. Mr. Vujcic, you first.
Thank you very much. Thanks for inviting me. It's a pleasure always to be in Athens, in Greece, with my good friend Yanis and all others. So on the topic of the financing, Europe, as you know, and it's not a new thing, is in a situation where most of the financing here is bank-based, and we have been discussing it for years. What we need to do really, and that has been the intention of what we used to call a capital markets union, which we call now savings and investment union, is to try to create conditions to mobilize more equity financing, particularly venture capital investing, both for the startups and then for the scale-ups. And this is something that is still ahead of us. We have made some progress, but most of it remains ahead of us. We also need to create other conditions for more of the equity finances. As we know, in Europe, corporate tax system favors debt versus the equity, which is one thing. Then this same tax system is fragmented. As we know, you have a very different tax regimes. For example, for the trading, an important thing is that you have a different withholding tax across the jurisdictions, which makes trading, post-trading more complicated. Some of these things we might think are the easy fixes.
Yeah.
Some of them are more difficult, more demanding, but we will have to try to create a more liquid, larger, and market without these barriers for trading, post-trading, in order to enable European companies to get financed for the innovation and to allow them to scale up so they don't have to go across the Atlantic to do that. We also have now, I would say, a relatively good environment for the startups. It's a bit different than the one across the Atlantic, in a sense that most of the capital that goes into that one is coming from the government, approximately 1/3. In the US, 1/3 of that money is coming from the pension funds. And much of it goes also through the European financial institutions like the European Investment Bank. But at the moment when these startups have to scale up, there will really lack a space for them, and we'll have to fix that. In some ways, problems are structural. As I said, if you don't have funded pension systems, you have less of a role of pension funds. If you look at the US, the largest asset managers like BlackRock are primarily funded by the pension funds. No. In Europe, we have relatively little funded pension schemes. In some countries we do. In most of them, We don't. So we have to find different ways to mobilize capital to push it into the equity and capital markets. And maybe this is where I have to stop given your time limit.
Yeah, that's good. With this, we'll come back to some of what you've mentioned as we have our discussion. But thank you very much for that introduction. Yanis, your thoughts?
Thank you. Thank you very much. And I'd like to thank the economists for the kind invitation. And it's a great pleasure to participate in this panel with the ECB Vice President, great friend, Boris Vucic, and the CEO of the National Bank of Greece, and also great friend, Pavlos Mylonas. Few things about the world economy. I think the agreement on the 17th of June between the US and Iran had led to an unexpected reduction in energy prices, close to levels prevailing before the war. And these developments, if sustained, could have led to higher growth and lower inflation compared to previous forecasts. And it is indicative that annual inflation in the euro area fell to an unexpected 2.8% in June from 3.2% in May. However, hostilities started again, so we are back to square one, and that shows how precarious and volatile is the situation in the Middle East and, as a consequence, energy prices. It also shows the uncertainty surrounding inflation forecast and therefore the challenges that monetary policy has to face. I'd like to zoom on the recent developments in the Greek banking sector. The Greek banking sector, as well as the Greek economy and the fiscal situation, has been a success. Banks now are well capitalized. They are financing the economy. They have, all the metrics are above the minimum requirements. So along with the fiscal situation and the macroeconomic developments, they form this success story of the Greek economy. I'll come to the RRF because the question is what's going to happen to the country when the RRF ends. We don't see a cliff. Greece now enjoys very high foreign direct investment from abroad. And also European programs continue. So we don't see in the Bank of Greece any cliff effect after the end of the RRF, which actually has played a very important role in the financing of the Greek economy. Net credit expansion now, as Pavlos will say, also runs much higher than nominal GDP growth. So there's ample financing for the Greek economy. Turning to Europe now, the great challenge is to complete the banking union, the savings and investment union. As you know, in Europe, we have much higher savings than in other parts of the world, especially the United States. We have a current account surplus of about 2.5% of GDP. That means that we save more than we invest. But up to now, most of these savings, these excess savings, are flowing abroad. So our main task now is how to use these excess savings to finance investments in the European Union, following the directions of the Draghi and the Letta report. So for us now, it is extremely important to complete the capital markets union and the banking union to cut fragmentation so that we obtain higher scale in Europe and increase the efficiency. So we have enough savings in Europe, but the question is how to turn these savings into higher investment, and especially higher investment in the digital economy, in the green economy, and in defense. So I think that's the main, I would say, task for Europe now.
Okay, I'm keen to explore that in a little bit more depth, which we will do in a second. Before I move on, I just wanted to come back to something you mentioned, the resumption of hostilities in the Gulf. which raises a question, I think, that's in everybody's minds. Are we in a moment of transition from one kind of peace and stability to a new kind of peace and stability? Or is this instability the new shape of the world? As a central banker, you would like to be able to see stability on the horizon. Do you see it?
I think there is a very close correlation of energy prices with inflation, and Europe is still a large energy importer, so it is crucial to have stable supplies from the Middle East. The resumption of hostilities means that these supplies have been cut again to some extent. So that has produced a lot of volatility. The Brent price is more than $80 today, this morning. It was lower than 70 a week ago. So that shows the volatility and how precarious the situation is. Nobody knows what's going to happen tomorrow, because there's a lot of uncertainty surrounding these developments there. And this is not risk. This is naivety and uncertainty, actually. It's unknown unknowns. And so we have to form our monetary policy having this in mind.
Right. I suppose what I'm thinking of is that, since 2007, 2008, we've just the world has had one crisis, one disruption after another. And, we might settle, who knows, we might settle the Ukraine war, we might settle the Middle East instability. But what's around the corner? Are we living in a just inherently more unstable world, and which makes planning that much harder? We can come back to that. Mr. Mylonas, MBG Group, an important institution here in Greece. Your thoughts, please, on this question of financing Europe and Greece's future.
Thank you very much. As I heard the previous speakers, I said, oh my God, they're taking away what I wanted to say. But let me try to keep the salient points. The question is financing growth in Europe. And as Yannis said, we need investment, we need more investment, and we need higher quality investment in Europe. And what are the conditions that will lead to that? I think for the first question, which is the conditions, as also Yannis mentioned, the lessons of Greece point a little bit to the direction that Europe should go in. And what do I mean? Greece gained investor credibility.
Say that again, sorry.
Greece gained investors' credibility.
Right.
How did it do that? One is the fiscal effort. Primary surpluses of 3 to 5% per year, year after year, including, as the Prime Minister said last night, meeting the defense targets of Europe. One of the few countries, one of the top 5 countries in meeting defense spending, despite having the primary surplus. It has done structural reforms. It has introduced a digital economy, many important steps in the digital economy, many important steps in the energy transition, has done great work on tax reform and tax collection. I can go on and on, but there was a successful structural agenda. And the final sort of requirement, I think, is political stability.
Yeah.
We have had political stability, not just in having one common government, but even the opposition is not at the extremes, as we've seen in other countries, dragging the discussion to non-sustainable solutions. So I think the confluence of these characteristics is something that Europe should look at, because they're not having a strong fiscal, quite the opposite. The fiscal is weakening. Very little effort, great effort, less success on Project Europe and other structural reforms within each country. And the politics, as we heard last night, was it 27? And 2027, we're going to have 10, 15 European elections with unknown results, as you said. So I think the path that Greece has followed, I think, is something that, if Europe can follow, it would benefit in terms of creating the conditions for investment. Now, the other thing is the quality of investment. And here, when we look at the US, and we often look at the US as the example, you see that fixed investment has 40–50% of high quality investment compared to Europe, where it's about half that. And that, I think, is one of the reasons that the US is seeing such high productivity growth compared to Europe. So how do you get higher quality investment? And here the question is, again, the Capital Markets Union. We need more risk-taking by the capital markets. The banks are not best placed for that. We have the deposits of the retail market, the mutual funds. They have the money of the retail market. That cannot be placed in high-risk investments. We need more private equity, more venture capital. If the conditions are right, they will come and they will invest in higher quality investments, and that will lead to productivity growth. So we need progress on that front, and let's hope that we can get over the 2027 politics and get down to introducing some of this stuff. And with that, I will stop.
Okay. I'm going to ask you a question I asked Prime Minister Mitsotakis in Crete, and I'm not sure he was entirely happy with the question, but I'll ask you and see how you feel about it.
That sounds like trouble.
It does, but I promise it isn't. You've mentioned, a lot of people have mentioned, the success of Greece. At the moment, if you sort of took a cross-section of the Greek economy today and compared it with 10 years ago, you would say things are looking good in pretty much every indicator. But of course, 10 years ago, things were looking really, really bad. And Greece went through a terrible period, real, genuine popular suffering in this country during the crisis. Does Europe need to feel more of a sense of crisis in order for it to have the motivation to do the things that need to be done to achieve what Greece has achieved?
Oof, that's a tough question. In my previous life, I worked at the IMF, and I always worked on program countries. And there was a sense that the countries that had difficulties were the ones that implemented the most far-reaching reforms. So in many respects, yes, pressure works. I mean, we all work best under pressure, so maybe a bit more pressure works. But how much more pressure does Europe need? You're seeing China and the US go further ahead. We were thinking Trump would give us a wake-up call, but I don't know. Has it occurred?
Yeah. Well, let's stick with you for the moment, but I'll come back across the whole panel for this question. We've heard these words: should, needs to, must. These are all the things. We know what Europe needs to do, what it should do, what it must do. Why isn't it doing it? So where are the obstacles? What are the blockages in the way to these obvious solutions of capital market union, banking union?
I will say something that will get me in hot water. You cannot have unanimity in governing Europe and expect execution. You need some form of majority, reinforced majority voting across countries. I know it's anathema in Europe to say that, but it's very hard to work with unanimity on these issues.
I'll just point out that's another need, should, must. And the question really is this going to happen? How do we make it happen? I'll come to you. What does Europe need to do to overcome the obstacles to banking union, capital market union?
It needs a higher aspiration, and we have to take into account that we are squeezed between the tariffs imposed by the United States, the mercantilism of China. So the answer on our part must be more Europe, more federal Europe, which means more coordination. And practically, we have two reports now that we have to implement. It's the Draghi report and the Letta report. So we're not blind. We know what is the pathway out. We're implementing these reports slowly. There is a certain progress. Practically, okay, let's be realistic. We cannot change the treaty so easily. Some of these requirements need a treaty change. We don't think it's the time ripe now for a treaty change because it needs unanimity, and we don't have unanimity. But we can have a second best. For instance, why not capital markets union? For this, you don't need a treaty change. Why not common debt? I see in the Eurogroup now and the ECOFIN there are some proposals to issue common debt. We have already done so with the RRF, with the NGEU. Europe has borrowed more than 900 billion euros. This has been a successful program. As you see now, we have convergence between the south and the north, perhaps for the first time in many years. Why should we do that for common defense, for public goods like common defense, green energy transition, technology? So there are simple things that we can do and implement very easily, provided there is a minimum political unanimity in Europe to do that. I mean, we have created the European Central Bank. We have created the SSM. So much more difficult things than capital markets union, or even what remains to be done to complete the banking union. So let's proceed. It's not difficult, and the benefits will be enormous. I think will be more scale, less fragmentation, higher return to investment. I mean, if you ask now wealth managers why they take this excess 3% of GDP savings of Europe and invest in the United States, they will tell you two things. Because the rate of return in investment in the United States is higher, and because the market there is much more liquid, because there is more safe assets. So this is what we need to do. We need to eliminate all the remaining barriers to trade in goods and services in Europe, and they are still high. All this regulation, implicit rules, imply, it's like tariffs actually. There is a study by the IMF and by the ECB, which it's like tariffs, and actually much higher tariffs than President Trump has imposed on Europe. The second is we need more safe assets, and for this we need to proceed with common issuance of debt.
Okay. Boris, I want to put this same question to you. How do we turn must and should into we have done it, we have achieved capital market union, banking union? Is it a question of qualified voting rules, or is there something else that Europe needs to do to get over this obstacle?
Well, you can think of it also in a way that if you asked some of these questions 20 years ago or 30 years ago, you would have not thought that Europe would get as far as it did so far. So
that's
things
why we left.
Things can be done. That's clear, but you have to have the right conditions. It's the union of 27 countries or 21 in a Eurozone format, which have to agree on different things, and they have in the past agreed on a very difficult things, some of them that you would not have imagined a few years before. Usually that was incentivized by some type of a crisis through which Europe was going through. Qualified majority would definitely help. It's easier to make decisions in that format, maybe not for everything, but for some things. When I think about the conditions to move things forward, I would think that this type of decisions, like on the Capital Markets Union, Savings and Investment Union, which involve different interests on different sides, you have better chance to pass if they go as a package than one by one. Because as a package, everybody has to give up something, and then it's easier for countries to agree. When you try to pick them one by one, it's much more difficult. But I'm sure that Europe will continue to make progress. It has so far. We always think it's too slow, and it is too slow. But it is a progress. It is the move in the right direction. We just have to do everything that we can, each of us in our own capacity, to speed up these reforms.
I want to pin you down a little bit. Unfair question maybe, but can you give us a date for when Capital Market Union, when you would put a bet on Capital Market Union being implemented?
I wish I could.
And you won't?
I wish I could. I cannot, of course.
1 year, 2 years, 5 years, 10 years?
The risk of being wrong is so high that
You
I
don't
won't do
mind.
it.
We're all wrong all the time. We shouldn't be afraid of being wrong. Actually, I shouldn't say that as a forecaster. Okay. I want to come back to you, Pavlos. You did mention the lessons that can be drawn from Greece's experience. I'd just like you to go into that a little deeper in the context of the conversation we've been having. What would you, if you had this job, or you were finance commissioner in Europe, or you had some responsibility in the European context, what lessons would you take with you from your experience here in Greece to resolve some of the challenges that Europe faces?
Again, I think what should be done is known. I don't think if you ask anyone in positions, high positions in Europe, that they don't know what to do. I think, and I'm probably misquoting someone, but I think it was a French politician said, we know what to do, we just don't know how to do it and get reelected. So I think it's the setup, which is difficult, with everyone having to agree, or many people having to agree, the many different positions of power. There's the council, there's the parliament, etc., which all have to somehow coordinate. It's not that if you listen to any one of them, they all have the right ideas. We have the maps created by Draghi and Letta. So the question is, in this big bureaucracy, how do you implement this thing when countries are in different phases of their electoral cycle? Some are strong governments, some are weaker governments. That, for me, is the biggest issue. And if you want to draw to the Greek experience, we've had a very strong government with a very strong reform mandate, and it's easier to do it when you have a majority in parliament and you just go through. It's not easy, but it's easy. It's easier. Yeah. So for me, it's not knowing what to do. It's given the setup how it trickles down into execution. Because execution is what we say at the bank.
This is the key theme that we keep coming back to in this conversation. Very briefly, because we're running out of time, I'd like to get a couple more questions in. A theme that is sort of perhaps a little more classically in the line of central banking. Europe, much of the world is observing, going through a cost of living crisis. How do you balance, in terms of monetary policy, the battle against inflation, against cost of living increases, and this absolute need for growth that all of the countries in the world, but certainly in Europe, have? As Greece's head of central bank, how do you go about doing that?
It is very crucial to have policy credibility. We know that low inflation is good for the poorest sections of society. The poor are more vulnerable to inflation than the rich. And also, don't forget what Lenin had said. If you want to destroy a nation, if you want to destroy a nation, undervalue its currency. So we have to keep in mind. And I think Napoleon Bonaparte had tried this with Austria, if I remember well. Right. So we know the lesson. We need low inflation if we want to have high growth and employment. So number one is policy credibility, monetary policy, and fiscal policy credibility too. There's no contradiction between the two, because if we keep inflation low on the part of monetary policy, then the long-term yields of bonds will also be low. So this is good for fiscal policy as well. So I don't agree with certain analysts who see a conflict between monetary and fiscal policy. I think monetary policy helps fiscal policy if it's credible. Right. But we also need fiscal policy credibility. And then in Europe, as we have said, we also need, because these two are necessary but not sufficient conditions for growth. We need investment. We need quality investment. Look at the progress in AI done by the United States. by China. We have the scientific personnel, but we need entrepreneurship to turn these ideas into innovation in Europe too. We have the capacity, but we have to proceed faster with the implementation of the Draghi and the Letta report.
Okay. Okay.
Just add
Come back
maybe
to
to
those
what
reports.
Yanis has said, that in the last inflation cycle, bringing it down, the success was not only just bringing down the inflation, but doing it with a very low sacrifice ratio in terms of the loss of the output, the GDP.
Yeah.
If you remember also at the time when we started to hike rates in the ECB, most of the analysts were saying that it's the Goldilocks scenario to think that we will not go into the recession
Yeah,
with this increase.
I remember.
In the end, we ended up with a very low sacrifice ratio, which says that at least in Europe, we didn't have that trade-off between the growth and bringing down the inflation.
I remember it well. I'm not sure central bankers ever really got the credit that they deserve
That's why I say.
for that. Okay. We're over time, so I was going to ask you a question about whether the projects exist out there to absorb all the money that you're trying to send their way. I'm sure in every case your answers would have been yes. So we've saved ourselves that question. So with that, we can draw this session to a close and hand back to Joan for the next one. Thank you very much, gentlemen. Thank you.
Thanks a lot.
Thank you.